What's up, guys? In this video, I'm going to give you 5 ways that you can immediately begin to boost your credit score today. A survey of US adults actually found that 79% of adults are actively trying to increase their credit score. But why? So your credit is a numerical value given to you by creditors to establish your credit worthiness. It ranges on a scale from 300 to 850 on the high end, and it's going to affect things like a personal loan, a mortgage, or credit card interest rates that you're offered from these creditors. So how do they find your credit score? Your credit score is actually calculated using 5 categories. Your payment history, which is going to be the heaviest at 35%. It's going to want to know, do you make payments and are they on time? The amounts owed, which accounts for 30%. That's going to be a ratio that we'll talk about a little bit later. And it really is not the amount that you owe, it's the amount you owe compared to the amount of credit you have available. Next is going to be your length of credit history, which is just your oldest credit account. After that, you have new credit accounting for 10%, and that's how many accounts that you actively have opened recently. And then lastly, you have credit mix accounting for 10%. And that's going to look at, do you have things like a credit card, an auto loan, a personal loan, a mortgage, or are you just using one type of credit? All right, guys, so on to our 5 steps. Step 1, click the like button on this video if you are a fan of information about personal finance, the economy, investing, or making money that's presented in an easy to understand way. All right, step 1 for real. Paying more than the minimum on your outstanding debt. A study found that 30% of Americans with rolling credit card debt are only paying the minimum amount on their monthly debt that they owe. Now, this is convenient, however, credit card companies make it convenient for a reason. And the reason that is because the minimum monthly payments don't typically cover the amount of interest you're accruing. So long term, they're making money while you're not even making a dent in your debt. So here's what you are going to do with that information. You are going to identify on your credit card statements or debt statements from wherever your debt is balanced. You're going to identify how much interest is being accrued every month. From there, you're going to set up an automatic payment to be at least the amount to cover the interest that you're gaining each month. Now, what this does is it essentially freezes your debt in place. You're not necessarily going to make a lot of headway on the amount of debt you owe, but the amount of debt you owe is also not going to increase, which is going to allow us to create a snowball effect. And what I mean by a snowball effect is from there, we're going to pick a credit card with the lowest balance remaining, and we're going to try and pay double what our monthly minimum is, while maintaining our interest payments on everything else. So once that credit card with the lowest balance is paid off, we can take the money from that credit card and roll it into the payment for the next credit card, and so on until all of your debt has been taken care of. So our next step actually works best when you pair it with step 1, and that is increasing your credit limit. I know. This step seems like the total opposite of what you would want to do for someone looking to increase their credit score. But the reason this makes sense is by increasing the amount of credit you have available, you decrease what is known as your credit utilization ratio, which is the percentage of the amount of credit you are using compared to the amount of credit you have available. Now, if you recall back to when we established how your credit score is found, you'll remember that the amount owed accounts for 30% of your credit score, but it's not as simple, like I said, of just the amount that you owe. The amount that you owe is your credit utilization ratio. It's looking at how much you owe versus how much credit you have available. Now, I know that's a lot of words, so let's run through a quick example. Let's say that you owe $3,000 in credit card debt. You have an available credit of $5,000. When you divide 3,000 by 5,000, you get 60%. So your credit utilization ratio is 60%. Now, if either A, you're able to increase that credit card limit to $10,000, or you're able to apply for another credit card or a different credit card or a different line of credit altogether that raises your credit limit to, let's say, $10,000, while maintaining the $3,000 you still owe. You have $3,000 divided by $10,000 gives you 30%. You have taken your credit utilization ratio and you've cut it in half to 30%. Not by having to spend a single penny, but just by increasing the credit limit that you have available. What the credit utilization ratio is, where do you want to be? Ideally, you want that number to be below 30%. So ideally, you want to be charging less than 30% of the credit you have available, which can sometimes be challenging. And like I said before, step 2 really works best when paired with step 1. So in step 1, we are paying down our debt, and in step 2, we are increasing the amount of credit we have available. So if you're doing both at the same time, your credit utilization ratio is going to decrease twice as fast. So step 3, we want to build a pattern of positive payment history. So this might be step 3 on my list, however, is going to be the most important step available that we talk about today for the long-term success of your credit score. So, as we've already talked about earlier in the video, your payment history actually accounts for 35% of your credit score. So, it makes sense that if you have a history of on-time payments, your credit score will reflect that, and the creditors responsible for giving you interest rates on home loans, auto loans, personal loans will look more favorably on that and give you better interest rates. Now, that being said, you're going to want to start with bringing current your late payments if you have any. Late payments cause more of a headache for your credit score than any one thing. So the faster you can bring them to current, the faster they'll fall off of your credit report and affect your credit score positively in the long run. And the easiest way to ensure that you are someone who has a positive payment history is going to be to set up automatic payments. So on to step 4, correct errors on your credit report. So this step can seem confusing if you've never done it before or never heard of it or don't know what you're looking for. But don't worry, I'm going to break it down for you and tell you how to do it and what you're looking for. You can actually get a free credit report for yourself from annualcreditreport.com, which I will link in the description below. So now you have your credit report. You're miserable, you're confused, and you don't know what to do. So let's establish a quick list of things for you to look for. You're going to start with incorrect personal information, your name, date of birth, and place of employment, your address, the easy stuff. Next, we're going to look for account errors, accounts that don't belong to you, closed accounts that you've previously closed that are still being reported as open. Next, we're going to look at balance and credit limit errors. If you are someone that knows the exact amount of money that you owe, then you'll be able to know by looking at this if they're saying that you owe way too much or way too little or whatever. The big one is going to be your credit limit errors. Back in step 2, we talked about increasing your credit limit. Is it saying that you only have $5,000 worth of credit, but you know that your credit limit has since been increased to $10,000? And lastly, and most important, identity theft indicators. So technology and the world have come a long way in being able to identify whether or not you are potentially a victim of identity theft pretty early on, most of the time before you even have a chance to catch it. But that doesn't mean you shouldn't still be ready and prepared to identify indicators. And the biggest one that you're going to be on the lookout for are hard inquiries that you don't remember making. What's a hard inquiry? Great question. So a hard inquiry is going to be things like applications for credit cards, a mortgage loan submission, submitting for an auto loan, submitting for a personal loan, anything like that. Now, if you do find any discrepancies on your credit report, what you're going to need to do is file it and report it to the reporting agency responsible for making that claim. And that will be in your credit report, whether it's Bank of America, Chase, Visa, any of these companies. And lastly, step 5. But first, a word from the sponsor of today's video. Nah, I'm just kidding. My channel is currently way too little to be monetized. So if you're still here, I just wanted to take the chance to give you a sincere thank you for that. and ask you to please consider subscribing to my channel if you've learned anything new from the video today. If not, consider subscribing just to watch my YouTube journey unfold from here. All right, on to step 5, seriously. Step 5 is going to be consolidating your debt. So this step and the options I'm going to present can sometimes seem controversial to other folks on the internet giving finance tips. So I want to stress how important it is that you're committed to slashing your debt and boosting your credit score if it's the route you're going to choose to go. The current average credit card rate in America is 27%. 27%. That is an absolutely outrageous number, and no one should be paying that. So, something to consider is potentially 2 different things. The first being the possibility of taking out a personal loan with an interest rate lower than the credit cards that you owe money on, or any other kind of debt. If you can find a personal loan for 10% and your credit card is at that 27%, then you could take your personal loan out, pay your credit card off, pay any other credit card you have off, and then all of your debt is consolidated into one spot. So you're not being responsible for making multiple monthly payments in different areas. So the second option that I brought up is one that I personally like better, and that's trying to find a credit card that has a promotion going on for a 0% APR. Now, a lot of these credit cards run these promotions for 6 to 18 months once you start a new credit card. As long as the credit limit is high enough, you can consolidate your debt. As long as the card is able to, you can transfer your debt from one credit card to another. Okay? So once you do that, again, you have all of your debt consolidated into one spot, or you can transfer your debt onto the 0% card and pay it off as you go. Now, what you have to be mindful of is when that 0% promotion ends. And there you have it. 5 quick and easy steps that you can take today to start boosting your credit score immediately. If you're still here, I appreciate it. I'm aware that my personality, humor, tips, and channel aren't going to be for everybody, but it's for you. Until next time, weirdos.